Hey everybody, Economic Ninja here. I hope you're doing great. Got a great story for you out of CNBC this morning, and it really tells what is going on in the real economy and in retail right now. Remember, retail is a great barometer, the earnings that come out of where the consumer is and how close they are to breaking and where we are in this recession and explosion cycle. But there's no explosion to the upside. I think it's more of a detonation to the downside. Here we go, out of CNBC. Target ekes out a slight growth in holiday quarter sales, but warns of a continued slowdown. It says right here, on Tuesday, Target topped Wall Street's earning expectations for the first time in a year as its holiday quarter sales rose roughly 1% from the same period a year prior. Still, the big box retailer revealed shrinking profit and margins and gave a conservative full year outlook, saying customers are tossing fewer discretionary items into their shopping carts. Now that is very, very important to realize. First off, a CEO knows that if things are turning down and they're going to get worse, they need to give a very broad, very longer term outlook to warn its investors of what is coming so that they don't see shocks in the stock price. The last thing a CEO or C-suite execs want is people to be surprised, alarmed, sell the stock and have the stock come plummeting down, and then it's harder for the company to raise money at a higher valuation, okay? So that is something that people need to understand. Another thing is when we're talking about these earnings that came out, these are earnings from the fourth quarter. And you remember I told you that in the first quarter of 2023, we're gonna start to see how bad the Christmas season was in fact, all right? Let's move on. It says the company said it expects that comparable sales, a key metric that tracks sales at stores open at least 13 months and online, will range from a low single-digit decline to a low single-digit increase for fiscal 2023. Target says it expects full-year earnings per share of between $7.75 and $8.75. That's below Wall Street's expectations of $9.23 per share, according to street accountant estimates. Let me stop there. Another thing you want to realize too is it's one thing to say things are going bad, things aren't looking good, right? It's another thing to just sort of glaze over and saying things aren't going to be where we expected them. You know, this fancy sort of Wall Street jargon to sort of ease you into the pain when we all know that by this time next year, things are going to drop even farther, and these numbers aren't even going to matter. There will be well below. And why is that? Because inflation is overtaking the consumer, and Target has all of this square footage that they have to sell goods, right? Well, Target doesn't just sell groceries, cosmetics, and other necessities that people need. And I'll get into the cosmetic portion in a second. But they have all this flooring space where they want to sell and need to sell TVs, furniture items, clothing, things like that, okay? So it's going to be worse than they say. They're just trying to ease you into this. Now it says right here on some of the bullet points, and we talked about how it rose, it slightly rose roughly 1% from the same period a year ago. He said right here, the CEO, Brian O'Connell, said he cited a very challenging environment with groceries, beauty items, and household essentials lifting sales as consumers focused on necessities. And that's something that people need to realize too. In a down economy, alcohol and cosmetics do really well. They definitely hold their own. Why? Because people want to feel good about themselves. Either they want to make themselves over to feel good, like nothing's going wrong, I'm losing my house, but it's okay, I still look good, or I want to drink myself into oblivion and I guess sit in the corner of the street. Those are realities. It's a very sad reality, but it's true. The other thing is food and then clothing, but clothing really takes a backside on the necessities because you start to see stores like Ross, TJ Maxx, and other discount retailers when it comes to clothing do well because the companies that are selling these high fashion items, like shoes with fur that stick out of the back end, I don't know why, they just go out because people don't have the money for them because they don't have the credit card balances to be able to put on it because credit got tight. It's just a really big, broad overview, but that's what's going on. So now, think about it. They inked out, and they said that December sales really is what boosted them up, but December was nothing like what it has been in the past, meaning people weren't spending as much on Christmas gifts, things like that. than they would be in prior years. This is showing how sick this economy is. And if you think about it, the Federal Reserve is still going to be raising rates into 2023, which means it's going to get even worse. So that is where you need to be starting to get ready mentally for being patient. Patience is a hunter's best friend. It is the hunter's secret weapon. And right now, you have to think about yourself as a hunter, sitting back, hiding, waiting with your ammunition, the ammunition being good credit score, money on the side, and your debt paid off, to be able to pounce and take that opportunity when that amazing opportunity with an asset comes your way. All right, guys, I hope you got something out of this. With that being said, the Economic Ninja is out.